morning, everybody. Welcome to the January 2024. Made any mistakes writing 23 and 24 yet?
Not yet.
MSMF Wealth Management Client Podcast. I'm joined, as always, by Mr. Cody Redding. Cody, Happy New Year.
Happy New Year, Mark.
And Mr. Jay Peters. Jay, HNY.
HNY, Happy New Year.
I hope everyone is doing well. I'm quite well. Missouri Tigers beat the Ohio State, what's their names, down in Dallas in the Cotton Bowl. And I'm happy because many of my Ohio State friends always told me they could beat us with their scrubs, and they didn't. So with that as a backdrop, I thought we did our Gloves Off podcast back in August of last year. Mm-hmm. I was convinced it would be a while before we did another one of those, but here we are, Gloves Off for the outlook for 2024. Okay, you guys are appropriately separated. I think I can dive into the middle if I need to, kind of like that bailiff did to save the judge he was working for. Sidebar, sorry. But let's get rolling. All right, so the question is, here we are, the outlook for 2024, and we don't agree again, okay? It all starts with, I think, topic of the day, many days in the last many months. Are we going to have a recession? Jay, I'm going to throw it right to you. Where's your head at on this?
Sure. So I think we're going to have some sort of a mild recession. I'll just put it right out there, right from the beginning. And in fact, you might even argue that we're kind of possibly in one already. Right? If you look at some of the things, for example, the S&P 500, let's rewind back to 2022, it was down quite a bit, right? So that's usually an indicator right from the get-go of if there is a recession coming. Well, that was a pretty rough year, so you might argue, hey, that's kind of the beginning of a recession right there. The other part would be the Fed's fund rate expectation. Right now, if you kind of look at what the Fed has said that they're going to do, it looks like maybe a couple rate cuts for 2024. Then if you look at market expectations, and the market's never wrong, right? But if you look at market expectations, they think it's going to be basically twice as much as what the Fed has said that they're going to do. So that right there is kind of a red flag of, well, someone's going to be wrong. Who's it going to be, right? In which case, is the Fed going to cave and start cutting faster because of inflation or whatever? I don't know. We'll have to see. And then the last thing that I would argue is, so in 22, when the Fed started raising interest rates, they increased them historically faster than they've ever done. And usually it takes around 18 to 24 months to see the result of any rate increase or cut for that matter. But usually it's around 2 years. Well, guess what? We're hitting the 18-month to 2 years for a lot of those rate cuts. So I'm curious to see if other parts of the economy has kind of been showing cracks based on this and how quickly we've been adjusting to it. Sure, inflation's come down, but at what cost? Is that going to slow things down that we're not ready for? So I think the Fed might be cutting rates faster than they think.
Wow. So, yeah, that inflation thing. I go to the grocery store, and my can of Spam is still quite expensive from what I'm used to, which is disappointing to me. But to your point, Jay, someone's got to be wrong.
Right.
And you think it's Cody. So, Cody, do tell. Recession, yes or no?
Well, I'm going to go no recession.
No recession.
Yeah. Well, I think the big things, I'll look at is, well, where are we at unemployment-wise? Still historically low. I think 3.7 was the last number out there, where 3.7%, where the 50-year average is 6.2. So got a lot of wiggle room in that space. But more importantly, okay, do we still have wage growth? It's still above average. So, the couple of those two things, it's really hard to have a recession when you got low unemployment and high wage growth. Not to say that can't change quickly, but those are certainly things to look at. And projected earnings, 2024, you look at the earnings for that, S&P 500, as an indicator, looks to be another record year. So the earnings are always the biggest mover of what's going to happen in the market. And then I also think we have a little history on our side with where we are at with the Fed interest rates. So historically, when you look back, if you go from a rising interest rate environment to a pause, which I think we've been in a pause since July, I believe, was the last rate hike. July or August, I can't remember.
Yeah, it's been a while.
But nonetheless, historically speaking, those next 12 to 18 months have usually been pretty good in the market. So I think we'll have the carryover from that, and they still in their back pocket if they things aren't looking up to what they want it to be. We're at a high enough level to where we can actually lower interest rates. That could help boost economic activity. So I think a lot of good things on that side. I think it would be a little bit too early for 2024 to be a recession.
Interesting. So you have the utmost confidence in Chairman Powell, is what you're telling me.
Yeah. Well, wouldn't go there, Mark, but
Do I need to use the word transitory?
Well, you were good at
I'm
putting words
just
in our mouth
saying
today. Yeah.
that the economy is very strong.
Okay. All right. So you guys are coming at it from two different points of view. Let me ask both of you then, because this is really what our clients at the end of the day are concerned with, is the impact of their money, and the impact of their money is going to be driven by the market. So Cody, you're saying no recession, a lot of factors there, a lot of wiggle room, a lot of levers the Fed can pull. What do you see potentially as how that could impact the market this year?
Yeah, I mean, I think we'll get a momentum carryover from the last 2 months of 2023. Again, it's the expectation that, hey, the Feds are going to lower rates at some point. Everyone is saying, oh, it could be as early as March. I'm more of they're not going to do that till the second half of the year. I think the Feds want to make sure that inflation is staying cooled off, that they don't, kind of yo-yo with the rates. And going back to earnings again, like I said, it's the biggest driver of what makes the market go up and down. And all the data we have today, it looks like those earnings will continue to be strong. And the equity market, yes, Jay kind of alluded to it, is a front runner of things to come. And like I said, I think we'll have good data to carry us through 2024.
Interesting.
And then we'll see what happens with the election.
We'll come back to that. All right. So no recession, you're optimistic.
Optimistic for 2024.
Yeah. Okay. So, Jay, I'm not going to say you're pessimistic, but you certainly don't share Cody's view on where we're at recession-wise. In your mind, let's say we have a mild recession. What are you looking at? What factors are you talking to your clients about what we might see? Again, it's all looking into a crystal ball, but what might we see in the market in 2024 as a result of your position on recession?
Sure. And, to be clear, I don't think there's going to be doom and gloom. It's nothing like that. I think it's going to be super mild in a textbook definition, not going to be like, nothing like the last recessions that we've had, right? It's nothing like that. It's just more of a textbook, check the box. Okay, yeah, that was a recession, right?
Sure.
Kind of like, oh, that was a minor earthquake, right? Is that what that was? Okay, let's move on, right? I think it's going to be more like that.
Okay.
In which case, I share the optimism as far as the stock market goes. I also, the economy is super strong right now. That's why I think it's going to be anything mild if we do have some sort of recession. So with that, for the first half of the year, I'm going to say I think all eyes are going to continue to be on inflation, the Fed, and what they're doing with interest rates, right? And so I think it's going to kind of bounce around for the first half of the year. We've already had some volatility in January. I think we're going to kind of continue with that and kind of look for something to be really good or really bad. And I think the first thing that is kind of going to be what Cody says. Unless something pops up, I think it's going to be all eyes on the election at some point because the Fed doesn't want that attention. That's not their goal. That's not what they want anyway. So I think towards the second half of the year, it'll be more decided on policy-driven changes in the market, right? So if this happens, then this part of the market can go up. And if this person gets elected, then this looks good, right? That sort of a thing towards the end of the year. And if history is any indicator, that's usually what happens. First half of the year, an election year, kind of just choppy. In the second half, okay, now we know what to do. Let's go.
But past performance does not necessarily predict future.
That's right. I said if right?
It's all good.
Right
It's all
on.
good. Gosh, I really was thinking you guys are going to get scrappy today, and now you're actually kind of coming back together. Jeez. So, okay. All right. So we could be in a recession. We're not already in one, could be mild. There are reasons still to be potentially second half of the year optimistic about the equity markets and return on portfolios and all of those things, right? No recession for the reasons you said, Cody. Optimistic for some different reasons than Jay, but I think if you add everything what you both said together, that paints a potentially decent picture for the market. Last year, right, as we all know, we always like to say it wasn't a very broad market. Well, in English, that means if you look at the S&P 500 index as a benchmark for the market, less than 10 of those stocks accounted for, what did we talk about yesterday, almost 90% of the return.
Pretty much.
Right. So it was the S&P 7 and the S&P 493, right? Two tails, right? So regardless of what happens with the recession, regardless of the factors, frankly, we would say look at all the factors, regardless of all that, and the potential impact of an election, which is a very interesting dynamic, which we won't get into now. But regardless of the outcome in the White House, regardless of the outcome in Congress, we've seen different responses to that historically. And the one thing I can say, and we've talked to our clients about this, quite frankly, what gets the best response in a market is when there's a division of power. No single party owns the whole deal, because normally they screw it up, to be fair. Right. So with all of that taken in, Cody, what would you say for our clients as we start the year in 2024 with some optimism but some uncertainty? What's the call to action? What are you telling your clients to do right now today when you meet with your clients here in the first quarter?
Yeah, I'd say with the good year that we did have in 2022, making sure that
23.
Sorry.
22 is painful.
Yeah, 23. That if making sure your risk tolerance is in check, but if you need to, now is a good time to rebalance as ever. And also going back with that is a lot of people do ask about the election and what happens in the market. There is really no difference from if you look at the end of the year, how usually the markets react. Like Jay said, yeah, there's a little bit more volatility in election years. But after the primaries go through, usually they kind of rebound back and go on the average returns. Big mistake people make is sitting on the sidelines. More often than not, data is stay in the market and your average return will be better over the long run than trying to guess what's going to happen. And just know that first half of the year probably be a little bit more volatile than normal.
You guys are going to be sitting in the same chair before this is over. Excellent, Cody. Yeah, I can't agree with you more. Jay, same thing. What are you telling your clients this quarter, the call to action, given what we're staring at in 2024?
Yep, I would add maybe start with your goal for your different investments, right? Look at your retirement accounts and how far is it till you're going to need them, or your different investment accounts and when you might need to take them out to buy a house or whatever you're doing, right? And then starting there with, okay, what's my goal for this investment? And then adding on top of what Cody said, let's definitely double check how much risk you're taking. If you look at, I wrote down a couple numbers since February of 2020, so right before COVID, right? Market went down 34%. And I'm talking about S&P 500. After that, it rebounded 114%. Then it went down 25%. Then it went up 33% last year. If you haven't been paying attention to your portfolio, it could be wildly different if you haven't looked at it, right? So just what risk are you taking? Is it time to rebalance? Is it time to shift risk here or there to make sure that it's for your goal? And I love what you said, stay invested, right? Long-term data shows over and over and over and over. The more you stay invested, the more disciplined, the better results are going to be. So basically the same thing again. Optimistic, but make sure you know what risk you're taking.
Yeah, let me ask you guys this. If someone has, they come into some cash, they have cash on the sidelines, what are you guys telling your clients about cash on the sidelines given all of this?
Sure, I'll go first. Number one is, well, do you have something you want to do with it, right? Because that's going to going back to the goal with it. Do you need it now? Do we need it in 5 years? Do you need it in 20 years, right? And then after that, some people are more comfortable if they're not investing it all at once. Completely get it. So that's where we're looking at maybe what we call dollar cost averaging, or let's put some of it now, some of it later, some of it later, some of it later, so that we're kind of not trying to guess and time the market. That's usually the short and sweet of it.
Sure.
What about you, Cody?
Yeah, I mean, same thing. What's the purpose of the money for? Is there a time frame we're working with, or if this is over the long run? I'm always of the opinion now is a better time than any time. But knowing what we know about volatility in the market, depending on the size of the account, sometimes it makes a lot of sense to dollar cost average, like Jay said.
Yeah.
So we're not trying to pick any certain point in time, and the market's going to do what it's going to do over a period of time.
That's a true statement, sir.
Yeah.
Jay, any final thoughts?
I think the last thing I would say is just reach out to us if it's been a while. If you haven't looked at what's going on, if anything we said worried you, then maybe we need to double check on how much risk you're taking.
Perfect. Cody?
Yeah, I'd say with the start of the new year, for those of you that have 401k plans, now is the time to up that contribution amount and get it started for the year. That's right. I think that's my takeaway.
Super. Next time when we have a gloves off session, I'm going to bring Nerf ball guns for you guys so we can at least get something going back and forth. So,
I like it.
Okay. Well, I appreciate you guys. I appreciate your time. Very much value your opinions. I think there's elements of truth in what both you're saying, particularly because you kind of reconverge relative to ultimately the call to action for our clients. And again, it's like I said before, I joke about it, but there is no crystal ball because of the uncertainty. There's always uncertainty. There is an effective means to manage that as best we can with the techniques that you guys talked about relative to portfolio management, goal planning, setting timelines, reassessing those timelines, when you're going to need the money. And like if there's cash, you need it this year, well, certainly we're not putting that in the market, right? So again, if you have any questions to Jay's point, please reach out to us. Pick up the phone and give us a buzz. Shoot us an email. You have the text line. Please feel free to share this with any of your friends and family if they've expressed some dismay in terms of what the future holds. There is always uncertainty, and like I said, there are ways to, as you've heard from Jay and Cody, who've been at this and have been successful wealth managers for over a decade for you, and you're at a decade?
Year 9, yeah, pretty close.
So my opinion, a lot of people's opinion, these guys know precisely what they're talking about, so give us a buzz, text us, email us. We will talk you off the ledge if you're on the ledge, or we'll get you moving again if you're kind of frozen in place. And let's see, KC plays Miami, but nobody can get access to it because it's only streaming on Peacock. What kind of money grab is that?
That's right.
And loser treading water. We'll see where we go from there. By the way, did the Rams make the playoffs? Damn it. Hope for a big L there. All right, folks. Happy New Year. Thanks for joining us, and we'll look forward to talking to you next month.